All right, this is Josh Campbell. Now, this is a very interesting one. We're going to talk about how the mortgage market works. Now, it's really amazing how many of our colleagues in the mortgage industry and real estate agents who are, quite frankly, very dependent upon the mortgage market really don't understand the mechanics of how the mortgage market actually works. So our objective here is to really give some understanding as to some of the logic that's in place, some of the reason that certain things work the way that they work in terms of jumbo loans and underwriting guidelines. So let's go ahead and get right to it. So we want to talk about understanding the mortgage market, why we have a mortgage market, how the mortgage market works, and really how to show off this knowledge. So we want to use this information and this knowledge to really explain why we have a mortgage market, how it works, and really show off this knowledge so that we can help gain some confidence and some basic understanding of the underlying currents that really make the mortgage market work the way that it does, give you a little bit of education on why things work the way that they do. And the reason that we have this primarily is to do with risk. And now there's two types of risk. Of course, when we think about it, we generally think of payment risk, and of course that's a big factor, but by and large that's already included into the formulas that are determined in terms of rates and mortgage insurance and all those different types of things. So the bigger picture is the market and the interest rate risk. So let's jump into that, talk about that for a second. All right, so let's take a minute and take a quick example of the perfect customer. All right, so this customer is buying a $1 million house. They have an 800 credit score, and they're putting $900,000 down, which is going to put them at a 10% loan to value relationship. Okay, let's just say, for the sake of example, and use simple interest to make the math easy, and at 4% interest, the rate of return on an annual basis would be $4,000. So let's just take an example and break this down and really use some round numbers that are exaggerated for the sake of illustration purposes. Okay, so this lender did this perfect loan at 10% loan to value, 800 credit score. They put down $900,000. They only borrowed $100,000. The question is, in a year from now, if interest rates go up to 8%, and we're in an 8% market, now again, like I said, we're just exaggerating for the sake of illustration purposes, but is that loan still worth $100,000? Okay, so they would be receiving $4,000 on an annual basis, but in a year later, that loan, compared to an 8% interest rate market, would really only be worth $50,000. In an 8% market, who would buy that loan? Now, they may not be interested in selling the loan, but if they were to be evaluated as to the amount of assets that they have, then they're going to be looking at basically being worth half of what they were previously against the current market. So believe it or not, even though you did 1 year ago this perfect 10% $100,000 loan with $900,000 down, 800 credit score, proving everything in terms of income and assets, and they make their payments on time, sometimes make them early, that same loan compared to a different interest rate market is now worth half of what it was just a year ago. Now, again, we're exaggerating for the sake of making a point here. So we certainly don't see interest rates doubling within a year, but just want to illustrate the point of how the interest rate risk far outweighs the repayment risk that's quite frankly already built into the loan programs that are available. So certainly $50,000 would not put a company out of business, but let's just say that company did $2 billion in loans. Now that would be $2 billion in. Let's just say that company did $1 billion or $2 billion. That would be a $1 billion loss. Now, that would certainly put a company out of business. They couldn't afford to do that. So this is why we have the interest rate market and the mortgage market as it stands today. Without a mortgage market, then in areas of in other countries and certainly in parts of our country where there's portfolio lending and sometimes in jumbo products, that's why you don't see fixed rate interest options. The rates are adjustable to account for the rate risk and the rate movement, so that it offsets the rate risk portion of it. So what's the answer? The answer is securitization. So let's start from the beginning. So as a borrower, the borrower goes to an originator. That originator takes the application, gathers all the documents, and submits it to the mortgage company or the lender. Now, once approved, that mortgage company knows that that mortgage and the rate risk, they need to get it off their books as quickly as possible. From the mortgage company, after the loan is fully processed, underwritten, then it ends up with a seller servicer, or it could skip that step and go directly to an aggregator, which is the illustration that we have here, which would be Fannie Mae and Freddie Mac. But either way, one of those two things are going to happen. So they could service the loan themselves and sell it to an aggregator, or they could deliver it to an investor that specializes in that, and they could be the ones that send the bills. Of course, Fannie Mae and Freddie Mac and Ginnie Mae and all of the different types of securitized mortgages that we traditionally see they're not set up to facilitate the payment of or the processing aspect of servicing the loan adequately. So they send that mortgage and a service release premium to whoever is servicing the loan, whether that was the original mortgage company or an investor somewhere in between. But ultimately, both of those entities realize that this mortgage, because of the rate risk, is a hot potato. It gets to Fannie Mae or Freddie Mac or Ginnie Mae, and they're called aggregators. So they pool all of these loans together, and they know that it's a hot potato too. So who has an appetite for this sort of risk? Well, it would be Wall Street. Wall Street can take these securitized mortgages that are collateralized by homes that are underwritten to a very specific guideline that has a history of performing, and it's all very much outlined within the framework of the parameters in which case they'll accept. And then once that has been through their auditing process, and it's quite frankly just a series of audits all the way around, then that loan is delivered on Wall Street. They securitize it, put it into your 401k or other types of accounts that are going to help you balance out the risk of a stock market versus in more risky asset classes. And lo and behold, you are in the mortgage business, and you didn't even know it because your 401k holds things like bonds and mortgage-backed securities. So we all think that the underwriting process works clockwise. It actually works the other way around. So Wall Street makes promises to the investor, that would be us, that these loans are going to perform. And Fannie Mae and Freddie Mac are responsible for making sure that they set guidelines and make adjustments where needed to make sure that the loans are performing that once they receive them from either the lender or the investor servicer, and it quite frankly just trickles right back on around to the borrower. So the borrower, the same person that is borrowing the money, is also the one that is lending the money. And so in essence, contrary to popular belief, it actually works in a counter clockwise position. If we're looking at this, it works backwards than what we would typically ordinarily think a financial transaction or a financial transaction would work in the traditional sense of obtaining a loan. So in conclusion, just to wrap this up real quick, What will what you'll notice here is that the majority of our customers and our clients and referral sources, and some, quite frankly, even some of our colleagues, misunderstand the process. And when you really understand it, and the reason that we put this together for you is so that you can have a better understanding of why we do some of the things that we are required to do, because that underwriting process, working backwards, ultimately is in the best interest of the end investor, which quite frankly would be you as a consumer. So if you have any more questions about this, let us know. But we want to make sure that we give you some extra information that maybe you didn't have before, and hopefully that makes the ride a little bit smoother as we go through the process, and you understand why we ask for some of the things that we ask for. It's ultimately to meet all the little requirements in between to move the loan through to the next step. Okay, so call us, let us know if you have any questions. You've got our contact information right here.